Hello everyone and welcome to our YouTube channel. Today we will talk about rise of robo-advisors. What do you think about when you hear the prefix robo? Probably a Terminator-like machine or vacuum cleaner or maybe eco-friendly volley if you are a cartoon fan. But some robots aren't actually robots. Robo-advisors, which we will talk about today, are intangible algorithms helping you build a diversified portfolio based on your profit-risk preferences. So, how do they work? When a user signs up to a Robo-advisor web or mobile app, they submit their customer data like investment goals, risk profile, time horizons, investment classes, experience, and financial situation via questionnaire. The system defines the SSA, strategic asset allocation, of the user and gives recommendations regarding the most appropriate investment strategy. There are several types of robo-advisors: standalone solutions, Wealthfront, Betterment, segregated assistants, fully integrated advisors like Schwab Intelligent Portfolios or Vanguard Digital Advisor, and Robo-advisor, Betterment for advisors. The growth of robo-advisor industry is really significant. For example, in 2011, Betterment had only 10,000 clients, while in 2021 it hit 500,000. So now let's take a look at the benefits of robo-advisors. First of all, it's accessibility. Automated wealth managers enable clients to get financial advice and manage investments without attending the branch physically. Cost optimization. Instead of paid for trades performing, investors are charged only for passive investing. Tax harvesting. Tax harvesting delivers nice perks for backers as asset losses decrease capital gains and reduce taxable income. Neutrality. Digital advisors are more objective than human advisors as they, or rather the algorithm, stay impartial. Of course, there are some limitations for smart wealth managers. Less personalization due to unified approaches and standard robo-advisor technologies applied to all users. Apps perform well only when the market is stable, so fluctuation may be a challenge. Given that robots are trained to fulfill safe long-term strategies, dealing with risky high-profit schemes may be hard for them. Limited recommendations due to the lack of user information. Personalized wealth managers are great for beginners with basic needs. However, investors with sophisticated requests may find them limited. Lack of dedicated regulation, which may entail the risk of conflict between parties. By 2025, the market size of robo-advisors is expected to rise by over a significant number, roughly 3 times the amount of assets managed by BlackRock, the world's biggest asset manager to date. So, how is the robo-advisor industry regulated? Currently, there is no specific frameworks for regulating digital wealth management advisory industry. Financial regulatory bodies in some countries adopt separate laws with requirements and rules for the emerging industry. The FCA states that financial advice isn't a unique service, and firms involved in wealth management should adhere to MiFID AML rules. FCA keeps monitoring the development of the sector and alters the current legislative base if necessary. But the point is that two major authorities on the robo-advisory landscape, the SEC and FCA, are strengthening the legislative base, and it may become more and more difficult for robo-advisors to attract new clients at profitable rates. There are several mainstreams shaping the future of the digital wealth management. Hybrid robo-advisors, a new generation of solutions, is actively developing. Advanced features. Robo-advisors are now improving algorithms to solve more complex tasks like needs-based planning, next best action, and retirement income planning. Banks entering the niche. Incumbents' activities in digital wealth management may boost the growth of robo-advisors. Consolidation. The main goal here is to bring all the services, digital advice, lending, insurance, banking services under one umbrella and make them more accessible for clients. The global fintech movement is followed by a rise of robo-advisors. Keen interest in this niche is driven by the benefits digital advisors offer to clients and players: a wide array of services, low fees, zero minimum investment requirements, accessibility and availability. The industry is developing even amid COVID-19 pandemic, and traditional banks consider it as a great opportunity to attract new clients. Recent Robo-advisors trends include wealth management service portfolio extension, consolidation among players, advanced AI/ML technologies, and hybrid portfolio managers with the human touch. That was all for today. Subscribe and I'll see you later.